Hi, Greg Weldon here with WeldonLIVE, and this is a live briefing to discuss the ECB meeting. And, pretty interesting. I think if you're thinking the ECB needs to be out of the QE game, then this is really what you would have thought you would hope for, and maybe kind of the best outcome from that perspective solely. I'm not saying this is the best outcome. There's a good outcome. There's not a good outcome. There's a big argument to be said that having QE at all, given what you have going on in Europe, is kind of, not necessary. At the end of the day, from $30 billion to $15 billion for 3 more months, September, October, November, December. So in other words, $45 billion beyond the end of December, and that's it, shutting it down. But then they go on to say the ECB expects the key interest rate to remain at present levels at least through the summer of 2019, and in any case, for as long as necessary to ensure the evolution of inflation remains in line with the current expectations of a sustained adjustment path. Now, that's a lot of words, and, no mention here, and it's going to be, interesting in terms of the press conference that's going on now to see what kind of discussion there is about the rise in inflation, about Spain, Germany, both above inflation. And within the ECB's convergence report, which was just published, it was interesting to note the inflation, the countries that, the ECB is looking at in terms of inflation are Hungary and the Czech Republic that we just looked at. So that's really interesting. But you have a serious situation there. You got 3% in Lithuania, you got 3% in Estonia, you got 3% almost in Hungary, you got, rising rate, in terms of the Czech Republic that has been high too. So how that all plays out against the stagflation and the decline in real GDP in Germany, the outright decline in Denmark's GDP, the slowing in retail sales, in many cases to below the inflation rate in each individual country, in many countries in the EU, including Germany. This is a serious issue, and we'll see how all of this plays out. But I think the pushback on interest rates, where there had been an expectation at the beginning of this year that they would be moving in the fourth quarter of this year and at least twice, if not 3 times next year, that's been wiped clean. So, that is wherein lies the rub. It has to be. There's no other reason that the 2-year SHOTC would be down here and kind of violating this trend line, which it got below on the Italian crisis, but never closed below. Well, here it's in a position to close below it. So, with an downside day, from above the 100-day moving average, which is now trending down and acting as overhead resistance. This kind of looks reversal. And a move below minus 68.5 basis points is a mini breakdown that's not on the back of a crisis. What is this suggesting? Is it suggesting that movement by the ECB to tap out is going to be that bad for Italian and Spanish bonds that the German yield has to go down? There's a flood of capital already here? It kind of does. It really kind of does. Or it suggests that the slowdown you're seeing already in stuff like retail sales in the economy and even German GDP, which nominally was down from 2.9 to 2.3, now against a 2.2 inflation rate that's only 0.1 versus 1.6 that it was in January. Is it suggesting that this is, ECB tap out is going to intensify the stagnation of the economy? And that's why German yields are down. Either one of those, I'd rather kind of think it's the first, I believe. The 2-year Bono is interesting in Spain. All the way down here on the 100-day moving average, actually got a tick below the previous reversal low. And then the ECB comes out and look what it does. All the way back to the upside. And here it is right now. This is missed by a tick here on the upside. So minus 11.7 is the breakout. Now, really kind of confirmed. It's a double top. It's minus 11.7 and minus 11.8. In terms of Italy, it's still closer to the low than anything else. The bounce was dead cat right to the 38%. We thought you might even get a little more, and you didn't, and that speaks volumes to the facts that we stated here, which is simple. Just because they didn't get a Eurosceptic in as the finance minister doesn't change the platform of the new government, which is to expand debt. And you can tell me all day long that the finance minister was, verbally intervening, so to speak, in the currency, in the bond markets here, by saying that we will reduce debt in Italy. It's not happening. Case closed. Wow. I mean, if we're all going to believe that one, then we've kind of, been totally brainwashed by central banks into believing whatever. But in that case, just don't buy that for a second. The total dynamic here is still bearish for the BTP, and more so now that the ECB is not there as a buyer. Not that this was a tremendous amount of buying anyway, but the problem is the supply goes up here. We looked at this in our Italian special from May 18th. The amount, and not only that, but more problematic is the yield flip. Because right now, some of the stuff rolling off is still pretty high yield. So you're not getting crushed here yet in Italy, but by 2020 and then especially in 2021, you are going to get annihilated on not only the increase in size of debt maturing, but the really low levels, including one bond that's coming due, one BTP bond that comes due in 2021, that's at 0.05. So it's going to be a lot higher than that, and that's going to be problematic going forward. In that vein, sovereign debt issue, Spain is an issue, Italy it's an issue, let alone, now that you're dealing with separatists that have more power, they're ruling in Italy, and they gain power in the transition to a socialist government in Spain. Case closed. And yet the ECB can publish its convergence report, and it talks about inflation convergence, it talks about interest rate convergence. What it doesn't talk about is debt convergence. It talks about deficit convergence in terms of the year-to-year fiscal situation. It doesn't talk about debt divergence. I say right here, this is kind of where you're at, and this is certainly the way Italy's looking at it, and it's right up, this is it. Maastricht is dead. Long live the five-star league coalition in Italy. And as if you thought, again, this was going to be okay. No, this was the program from the beginning, okay? And now it is boiled over, well said here, in terms of Italy and France are at odds. You have a division now becoming more well-defined in Europe. Okay, hardliners in terms of like the Czech and the Hungarians, the Eastern Republicans, against countries like Austria and Italy and Greece. I mean, you have Greece too, because Italy and Greece feel they unfairly get the bulk of them, and France promised to take a whole bunch of immigrants that they haven't taken, and all of a sudden you got a major brouhaha that exposes Europe for its biggest single risk dynamic at the moment. In that vein, where's the euro? Well, the euro kind of rallies on this and then fails. I mean, do we have the follow-up? Yeah. Let me say you have an outside-downside day in the German 2-year, and you have an outside-downside day developing in the euro currency. You're all the way at the low here, after being higher, right off the meeting. Then let's talk about stocks real quickly, because frankly, this could be sweet spot for the DAX for a time being. I look at this pattern. I mean, here's your crack. You didn't break. Here's your little, hiccup on Italy. It's a double bottom. It's actually head and shoulders on these three bottoms, right in the 38 to 50%, right in the 100-day and 200, which have just moved up and are expanding their bullishness. And you hold here and you get above 13,000. And this doesn't look too bad. So maybe there's a thought process around buying the DAX against our short Italy and Spain positions, which we still like. I mean, Spain is at the high of the day, but it's still lower than it was a week ago. And in terms of Italy, the price action's lame. Okay, now if you get above 22,400, then we can start to talk. But until that happens, this still remains very much vulnerable, very much a breakdown. If I'd almost rather be long Germany than cover my Italian position. Much more on this tomorrow. I have a gigantic piece on the U.S. in the works. I got to go now run the retail sales numbers. But I can tell you the budget numbers from late yesterday too. Wow, really worth looking at. The import price numbers, really important. Throw it in with PPI and CPI, man. You got a real situation here going on in the U.S. And the question already, a day later, is the Fed falling behind the curve every single day here relative to what they have now told us and fulfilled to some degree, really almost there fulfilling, where they believe, between 2.25 and 2.5 is the level of neutrality. Is neutrality already pushing to 3? Are we already behind the curve? I think there's a really good argument to say the answer to that question is yes.